Hope everyone's Thanksgiving was good. Tom probably got a big laugh out of that one.
Love the fixing the hair. That's awesome.
Uh-huh.
Hi, Rick.
Yeah.
See you.
Hey, Marianne, nice to see you with us.
Just in case y'all want to know, this is what goes on with 5 women in the office.
That's right.
You know, look at Kelly's hair, how perfect it is. And then you see mine.
Oh,
I got some flyaways.
Debbie said the wine they got from Happy Hour was great. Excellent. Glad you enjoyed it.
Yay. Awesome.
So yeah, you guys get to see the little inside there before we knew you guys were on there.
Yeah.
All right. Well, it's 5:30, so we should probably get going.
Let's roll.
People will probably pop in as we get going. Oh yeah, there's Eric. Hi, Eric. Hi, Kathy. Hi,
Hi,
Ramal.
Derek. Marlene.
We're so glad you guys are all here with us for Happy Half Hour. We're starting to get
Well,
it down.
What we want to know though.
5. Happy Half Hour number 5 that we're on.
Okay.
And today's theme is the 4% rule, fact or fiction. So Christina and Nancy are going to talk a little bit about that. Before we get started, I like to start with the theme for the day. Today's theme for the day is Disney Day. So if there's any people out there who love Disney, if you want to share in the chat just for some fun, like the last time any of you visited a Disney theme park, or if you have a favorite ride or a favorite memory that you want to share in the chat, just kind of fun. It's just kind of fun to share, but you know, everybody, who doesn't love Disney, right? So I guess on this day, he got things rolling. So, and it wasn't even until 1928 that Mickey Mouse came along. But he started in 1919 as an illustrator after returning from World War I, Walt Disney. So anyway.
We love
cool.
Disney.
What's that?
We love Disney.
Yeah. I can tell you a fun fact about Walt Disney. I read once where Walt Disney, where he has the property in Orlando, he saw this land and he was surveying it and checking it out and thinking, God, I'd really love to build an amusement park. It's so well needed and blah, blah, blah. He goes to Art Linkletter and he says, I have this great idea. And Art says, well, let's see the property. He goes, I'm not buying that piece of, you know what? Heck no, I'm out.
Really?
And that's pretty cool.
Oh, nice, Kathy. She took her son Alex on Space Mountain. He was 5. How do you like it?
She says he was fine. I was petrified.
That's awesome. Love that. Well, most importantly, Kel.
Yeah.
Happy half hour.
Yeah. What is everybody drinking? I'm still in the office.
Drink of choice.
I'm drinking water
Here.
but I'm drinking water today because I'm still
Coffee here for me.
Not at home yet. But I hope you guys are all drinking something yummy, and please share what you're drinking.
Now that we're getting into the full swing of the Hoff, French rosé here,
rose.
Kathy, like that.
That's rosé.
Very
I had
nice.
some nice cab yesterday, man. Whew.
So did I.
An Italian wine. It was so
Red
good.
wine. I wonder who that is.
Moon Haze by Blue Moon.
Still water for you. All right, Deb.
Eggnog with brandy. Yeah.
Whoa.
Nice.
Oh, that's
Way
festive.
to go, Barbara. Way to go.
Nice.
That's very, very festive. All right. Well,
Love it.
I know you guys are hanging on every moment here to hear all about the 4% rule. So without further ado, I'm going to go away for a little while, and I'm going to let Nancy and Christina kind of take over, and we'll talk to you guys in a little bit.
Okay, Kel, thank you. So as always, we want you to interject with any questions. Nancy will be kind of managing the chat. So any questions that come in, we'll certainly address them for you. But this is an important topic because in our practice, we always want to set realistic standards with our clients to achieve the highest probability of success. So oftentimes what's asked of us is, really, Christina and Nancy, what's a safe amount to withdraw from my portfolio every year to make sure that I don't deplete it too quickly? So what was really the founding topic in this area was established by a gentleman who was actually a financial advisor as well back in the 90s, Bill Bengen, and he actually established the 4% rule. And really the premise behind it was taking a 4% withdrawal rate. So withdrawing 4% from your nest egg would ensure that you would not run out of money and it would last the rest of your life. So there's still many individuals and financial advisors out there that adhere to this rule. And so we want to discuss this to share with you some thoughts behind it as you think about what you're taking. If you're retired right now, how much you're taking from your portfolio, or if you're getting closer to retirement. This is very important because we all want to make sure that our money lasts as long as we need it to. So let's kind of dissect this a little bit and talk about why taking a 4% withdrawal rate may not be the best course of action going forward for a person going into retirement. And then I'll finish off by kind of giving you some numbers and some data of two different scenarios of how this really plays into the real world. So when we think about withdrawing a 4% withdrawal rate, and we think about that maybe 30, 40, 50 years ago, and how that may have been appropriate. But when we think about today's environment, I'm going to ask you this question. What would you think when one of the number one reasons why that this particular withdrawal rate, a 4% withdrawal rate today for people nearing or in retirement, may not achieve the highest probability of success? What would be one criteria that would lend to that not being the best option these days? Someone said inflation. That's a great one. What would be another reason that would maybe put us at risk of our money not lasting as long as we need it to? Recession. Okay, these are coming in very quickly, but someone hit it right on the head. It's longevity. We're all living longer. And if we think about it, 40, 50, 60 years ago, certainly with Social Security. Social Security was never intended to be paying someone for 30, 40 years of their life. So our life expectancies are so much longer today. And that's one reason why having to take more of a conservative withdrawal rate early on in retirement needs to be considered. So the other important aspect that's oftentimes ignored when people think, well, 4% is a safe withdrawal rate, that's what I'm going to take, or it was thought to be a safe withdrawal rate, is that it does not factor in the taxes on your withdrawals. It's just saying you're taking out 4% and you have those spendable dollars. And for most of our clients, the vast majority of where they have their money today is in their retirement plans. And we all know that we have a partner in our retirement plans, which is the IRS. So you take out $1, you do not get to spend $1. Another factor that needs to be considered in the withdrawal rate that's taken is the low interest rate environment that we're in. And it's kind of the perfect storm in today's environment. Very low interest rates, high valuations of stocks, and that could be a slippery slope to manage. So these right off the bat are reasons why that in reality, if a person is thinking, gosh, I may need to fund my living expenses, my lifestyle for 30 years after my earnings potential is gone, really begs, more discussion on what really is a safe withdrawal rate. And many experts out there today that study this field are saying that that's not a safe withdrawal rate. So we'll get into this a little bit more. So how can we manage this? Because the biggest risk, and many of our clients are going to be familiar with this term because we talk about it a lot. The biggest risk that we all need to manage in our distribution years, because there's a distinct difference here. There's our years that we're saving our money, and then there's our years that we're spending our money. So this whole discussion is about the years that you're spending the dollars. They're called your distribution years. And the way you invest has to be distinctly different than what you did when you accumulated. And it's not to say that having equities or stocks in your portfolio during your distribution years is not appropriate, but it's just the way you manage it. So this is one way that we can manage what we call sequence of returns risk. And all this means, and you can certainly Google this, an individual that we follow a lot is an individual by the name of Wade Pfau. He's a professor at at one of the colleges for financial services, and he studies how a person distributes their income in retirement makes a significant difference. So one of the ways that a person can manage this is how you spend the dollars, and quite simply spending less early on in retirement, or being flexible in the way you spend, okay, having some flexibility. And it's all about your cash flow, and how a person manages that cash flow will determine the longevity of your money. The other key is managing volatility. So how we manage risk, the risk that we're exposing our money to within a 10-year period of time before retirement. Because any volatility that you'll experience, the closer you get to retirement, makes a bigger impact on how long your assets will last. So that's something else that needs to be addressed. The other way of managing the sequence of returns risk is by incorporating what you call buffered assets, okay? Now, buffered assets is something that, or is a term, I should say, that a lot of people may not be familiar with. But the clients that are working with us, this whole concept, as I discuss it, will be very familiar, because where we start when we plan is what we start with the end in mind. And that's starting from a foundation of income, because there's no retirement without income. When you stop working, as many of our clients on the webinar today can attest to, is that you still need income. It's just not coming from a paycheck. It's coming from the assets you save. So what a buffered asset just means is that you're using an asset that's not correlated to the stock market, okay? So it's not going to be affected when we experience volatility in the market, okay? It's not one for one correlated with the stock market, and that's key. And that's very key. And we incorporate non-correlated assets into our clients' income plan, because we do not want your income to be 100% affected by volatility in the market. You don't want to have to say, well, Cristina, I have to significantly lower my spending because my portfolio is significantly down. So let's talk about some strategies of how we can incorporate a buffered asset. Well, one buffered asset that oftentimes people consider as a strategy to manage market risk in retirement is by carving out a certain amount of cash from their portfolio. And we've had people tell us all the time, well, Cristina, I'm going to keep out a year's worth of my my budget, my income needs. So if we go through a volatile time, I can stop taking from my portfolio and I can utilize the cash. Okay, so and that could be a resourceful strategy, but what you have to think about, is that the most optimal way to tackle this? Because if you think about your portfolio, and if you're taking out a year or maybe two out of that portfolio and just setting aside in cash, then that's a smaller pool of a person's assets that they could have growing for them. So when they are taking money out of that smaller pool of assets, that withdrawal percentage that they need to take out may, in many cases, have to be higher than what you originally set as a target, because you have a lower pool of money you're working with, because you took out a significant amount out of that portfolio. So it may give a person a sense of security, but it may not be the most optimal way to handle a sequence of returns risk. The other, as I mentioned earlier, is managing volatility more efficiently. Okay, so this is what you want to think about, is that if you have a non-correlated asset that's not going to be affected by a downturn in the market, that gives you more leverage to say, I'm going to stop taking from those assets that have depreciated. Because if a person is relying 100% on the market for their income in retirement, when the market goes through downturns, we look at, the pandemic we went through, yes, was very significant and was impactful, but we certainly have gone through downturns in the market that have lasted as far as volatility or the market being flat for longer periods of time. I mean, we look in the early 2000s, 2000, 2001, 2, and 3, significant volatility lasted a lot longer. So when we look at other alternatives, and I just want to preface it by saying that the intention in today's discussion is to not make recommendations. There's certainly people on this call that we don't know your situation, but they're just strategies that are out there in the financial industry that people can think about and utilize. So one, we find people that have significant cash value in their life insurance contracts. And the thing to understand about insurance in general, what is this? It's a pooling of dollars. It's a risk pooling. That's what insurance is all about. Because if I own a cash value life insurance policy, I'm insured, and the insurance company is insuring a pooling of risk in these contracts. So if you have cash value that you can tap into, then what you're in essence doing is now you're taking from an asset that has no impact from market volatility, and you can stop taking from market assets. So that's one type of strategy that we've seen people that have come through our doors utilize. They were using the cash value from their contract for 6-8 months to offset not taking from their investments. We've seen some people that utilize a HECM, a reverse mortgage, as an alternative asset, non-correlated. And I want to tell you this, that everything has its pros and cons. And we're just here to put out different ideas and strategies, but you certainly have to consider your specific situation. So in a nutshell, using a buffered asset is just a way to say, I'm going to turn off this light switch and I'm going to turn on another light switch that can be more efficient. Last strategy is annuity contracts. So again, this is all about a risk pooling of investors' dollars. So again, having a portfolio of equities is, I'm not saying that it's not appropriate to have that through retirement, because you need to have some strategies in place to keep pace with inflation, right? Your money needs to continue to grow. But if you can have an asset that will continue to pay you an income regardless of whatever market environment we're in, that is very, very strong. Because the weakness in an all equity portfolio goes back to the two biggest risks that we face: longevity risk and sequence of returns risk. It's very hard to manage that efficiently and effectively just using a portfolio of equities. But when you start to incorporate these other buffered assets, an income stream from an annuity, some people have pensions that checks in the mail every day. Some people have real estate and the other assets that I mentioned. These are all ways to increase the probability of success. Okay, so Nancy, I saw some questions coming in.
Yeah, yes. So this is awesome. So this is a question that came in actually to me, and that's fine. You have a question you can do to everybody, but sometimes I just get the questions, and that's fine. They asked, so do I have what they called a personalized pension plan? And the answer is, kudos to you for remembering the lingo. And I see a lot of people on this call, and a lot of you have what we call personalized pension plans, because some of you may have pensions. I see a lot of you that I recall that do not. And some you do, but sometimes we need to offset that monthly because we know what your expenses are, including inflation and taxes every single year. So we always incorporate that. But you want to explain that really quickly, because I know we're running out of time, the personalized pension plan, because there are quite a few people on here that
Yeah,
are not clients.
Yeah.
And
so just real
briefly?
quickly, because there's one, the data I want to show you real quick before we finish.
Oh, yeah.
So many people are familiar with pensions from the corporate arena, right? From the public sector, if you work for the government, things of that nature. But more and more people don't have that anymore, right? So creating your own personalized pension is just saying, I'm going to go out to the private sector now, where I have a lot more options to create a sustainable and predictable income stream. So the stance that Nancy and I take when we help our clients plan is that we have to be creative. Days of old where there was two distinctly different ways of thinking in the financial planning arena is, one is we're going to manage all our clients' money in the market, and two, another advisor is going to look at very conservative, streams of income plan. Well, Nancy and I have found over our years of advising clients is when you can combine strategies together, you have more probability of success, and that's what it's all about. So, Nancy, I'm going to switch over to the graphic real quick, and I'm going to kind of go through it quickly. I do want to say there's a lot of data on these charts, and we take it a lot slower on one-on-one, but the point we want to illustrate is the impact that market volatility has on your money when you're taking it out as income when you retire. So let me just share my screen, and Nancy, if there's a quick question you want to answer while I do that, go for it.
Yeah, well, and when you look at the chart, understand that average rates of return, we throw them out the window once we retire, because the sequence of returns is like, wow, what if you retire and all of a sudden you have a negative, 15% in the market and you're pulling money out? Average rates of return of 7% is great when we're putting money in, because when the market's down, we don't care because we have time. So that's what Christina's going to go over with you.
Perfect.
To show
okay.
you the different.
So as I said, there's a lot of data, but this is a common denominator. We have two portfolios, portfolio one, portfolio two. Each individual, these are two individuals, they have a beginning balance in their portfolio of $1 million, okay? So they're each going to take out a stream of income of $40,000 a year from this portfolio. We put an inflation rate on there, 3%. So the data looks at a period of time between 2000 to 2020, okay? The difference amongst portfolio is portfolio one is really just following an unmanaged index benchmark to the S&P 500. Portfolio two is using more of a diversified portfolio of equities, fixed income, maybe some alternatives, real estate, things of that nature. But this is what we want to point out. So let's look at portfolio one. So this individual started again with a balance in 2000 of $1 million. Remember I said earlier that 2000, 2001, and 2 had significant downturns 3 years in a row. So timing's everything when we retire, right? So the first 3 years in retirement, the market was down. And for people like yourselves who've been investing for decades, they might say, well, 9, 12, 22%, I'm just going to hold on and let it come back. And that's a true statement if you didn't need income. But the change here is that you're taking distributions now. You need money. And we're including a 3% inflationary factor because we know things get more expensive as we go through different cycles. So look at the difference, the impact. 40,000 withdrawal and a 9% downturn, you lost $90,000 due to market volatility, and you took 40,000 out. So now you're down to 869. Next year you lost 12%, so 104,000 down, and you took out 41,200. So you can see where we're going here. And then we look at 2003 and we can say, well, gosh, Christina, the market came roaring back and made 28.5%. But that 28.5% is on a significantly lower balance. Okay, that's the impact of negative returns shortly into retirement. So at the end of that period of time, even though this portfolio averaged 8%, which arguably we could say that's a pretty healthy return, Cristina. Even with that, because of the volatility early on in retirement, this portfolio in 2020 was now valued at $314,000. Okay, with a little over $1 million in withdrawals. Okay, now let's look at portfolio 2. The primary difference here is we didn't see significant volatility early on in retirement. Okay, none at all. So same person taking out $40,000 a year, but look at the difference after, say, the first 3 years. That portfolio is still hovering around $972,000 compared to this one almost cut in half. So at the end of the day, same withdrawals, as you can see here. This person took out $1,074,000, same here. The other thing to note is the rates of return on the two portfolios are exactly the same. The only difference is how those rates of return showed up is called sequence of returns, where they showed up. For one person, they showed up very early on. For the second person, wasn't significant. Okay, there was some negative returns, but not early on. So at the end of that same period, look at the significant difference. This person's portfolio is over $2 million compared to $300,000, taking out the same amount. So the reason we wanted to share this with you is because this is something that we focus on heavily for our clients, because we're working with you in your distribution years, and we need to ensure as much as possible that your money is going to last as long as you do. Vance?
No, I just want to say, Tom said he wants option 2, and that's what we want for our clients. We want option 2. That's what we strive for. Thanks for that, Tom.
All right, well, if anybody has questions and we didn't get to them, you know, feel free. I did put in the chat a way for you to schedule a 15-minute call on Nancy and Christina's calendar. If you have questions about this strategy or your strategy, anything. But I was about to interrupt, so good job on the timing there, Cristina, because I was like, we're getting close to 6 here.
Timing and everything.
I have a festive holiday box that I put all your names who are on the call today in that I'm going to shake up, and I'm going to pull out this week's wine winner, our happy half hour wine drawing. So who will the lucky winner be this week? Kathy W. Congratulations. You're this week's happy half hour wine winner. I'll be in touch with you tomorrow to talk a little bit about the kind of wine that you like to drink, and we'll get that sent out to you. And I just want to let you guys know that our next happy half hour is in 2 weeks on December 20th, the last one of the year before the holidays. And the topic is going to be annuities, the good, the bad, and the ugly. So some of you have already registered. If you haven't yet, look in your email for the email registration, or just send us an email at info@moneywiseaz.com and we'll get you signed up.
Thank you all for the great comments this time around. Love them.
Yeah, it was great. We got 2 minutes to spare, so we did a good job.
Yeah.
So hopefully you guys all have a wonderful evening.
Yeah. Sorry, Kel. Look at Tom. Tom said his life is not going to last that long since we keep giving him pies.
We got to cut down the sugar.
That's
right?
a good one. Hey, next time we'll get you sugar free. That's kind of boring, but we can.
Or we can get you a bowl of fruit.
Yeah,
Yeah.
there you go. It's the holidays. You got to enjoy a little bit. Boring.
Okay, everyone.
Exactly.
Nice to see you.
All
Thank
right.
you
You
for
guys all
joining
have a
us.
great couple of weeks, and we'll see you again back here in 2 weeks.
Bye-bye.
Take care.
Bye.